What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
This week, Stephen and I will be talking with Craig Johnson, who is a Managing Director and Chief Market Technician at Piper Sandler, where he directs the firm's technical research group. Since joining the firm in 1995, Craig has produced market-focused technical research and regularly shares his views on CNBC and other leading financial outlets. Craig is a former president of the CMT Association and currently helps lead the Technical Analysis Education Foundation, reflecting his long-standing commitment to investor education and the discipline of technical analysis.
Stephen, good to see you again, and welcome, Craig Johnson. Craig, for the audience, why don't you kick off the conversation by telling us a little about yourself, a little about your framework, and how you see the markets today?
Absolutely. Thanks, Michael. And by the way, congrats on the #1 AI ranking. I can't tell you enough. We appreciate the hard work and great things you've done. Now, in terms of myself, our framework is pretty straightforward. We work as Piper's technical market strategist. We are looking at price, we are looking at volume, we are looking at the internals of the market, and we're always looking for inflection points. And part of our framework boils down to just really defining what is trend and what is relative strength in the market. I think that's a pretty straightforward way to think about things. We got just a handful of indicators that we've used over the years, Michael. And as we put those indicators together, it becomes sort of the foundation, call it framework, for creating our morning notes, our weekly reports, homework grids that we will customize out for clients, our monthly reports, the model portfolio that we manage. All those pieces will come back to the framework where we're defining trend and relative strength. I've been at Piper now for 30 years, enjoying myself every day, and hope to be around for maybe another 30 years. We'll see, though.
Awesome. So what are all those tools currently telling you about the market? Obviously, we've had this huge rebound since April. Investors are very focused on how the market's going to end the year. And where do you see things in the short term? Then we can talk about a little bit longer term into 2026.
Yeah, I mean, if we sort of look at how these tools have progressed through 2025, what I will tell you is they got extremely oversold at the lows back in the April timeframe. And when we get to those sort of extreme readings, it is usually an opportunity to step up and sort of be making noise, getting louder about why we should buy the market. Now, fast forward to where we are now, those tools have already recovered. Our trend tools, our MACE indicator, our 40-week, and our relative strength ranking pieces, two of them specifically that define trend. First is MACE. That particular indicator right now, when I look at every stock above a 25 million market cap and a $2 price, it is showing me that there are more stocks in downtrends based upon our MACE work, which is again using a 4, 13, 26-week moving average crossovers to define trend. There's more stocks in downtrends and uptrends. And then if we look at our breadth measures, such as our 40-week technique indicator, which is where we look at our industry groups, which we have 416, and the 4,000 rough stocks that we're looking at, that has started to contract and has been contracting since the end of August. So we are seeing a narrowing in breadth, Michael, is what we're seeing at this point in time, and it has actually flipped into a sell signal a few weeks ago. Now, historically, when this indicator has flipped into a sell signal, sometimes it has been a good signal, sometimes it hasn't been perfect. But at this point in time, coming off of these lows, this market is probably due for some sort of shorter term setback or correction. I don't always know what that's going to be from a technical perspective. I'll usually look to others here on the macro team at Piper to help identify what that issue might ultimately be. But stocks are reflecting some sort of unusual behavior in terms of narrowing breadth below the surface.
That makes sense, Craig. We're definitely seeing over the last few months some divergence in market multiples between the different size indices. We continue to see the strongest multiple expansion in the largest, think of Mag 7 group like names. And, we're in the middle of earnings now. We've gotten mostly good earnings from some of the larger companies. And at the same time, you are seeing better earnings breadth pretty much across the board for the first time in a couple of years. Yet we have seen a bit of under the surface, as you highlighted, quite a bit of weakness and some pullbacks, and particularly in a lot of the names that went up a lot in the last several months, perhaps largely on the reason that we were going to get a bunch of rate cuts. And of course, in this week's FOMC meeting, Powell said that a rate cut in December is not a foregone conclusion. He clearly wanted to emphasize that point. And, we've seen now the 10-year back up to about 4.08, which is, de minimis, but, clearly the market and investors are very focused on the next Fed move, the next employment data point, the next inflation data point, and where rates are going. So I think you and I both kind of agree that for breadth in the market to continue, we probably need rates to either move sideways or even continue their downward trend. What are you seeing from the rates perspective in terms of the 10-year bond yield?
Great question, Michael. And again, let me just say, I agree. When I go back and I just look up a summation of bottoms up earnings revisions from the S&P 500, 400, and 600, the earnings numbers are all moving in the right direction, which is clearly supportive of the market. In terms of what I see in terms of 10-year bond yields and 2-year yields and those kind of things, first on the 10-year bond yield, we have experienced probably the biggest technical change just a few years ago in 10-year bond yields, where we reversed a 40-plus year downtrend. And what I've seen from doing this for 30-plus years is you don't reverse a downtrend like that without having a period of backing and filling. I look at what we got going on with 10-year bond yields just over the last several years, and we've got this backing and filling that's been taking place right now. In the short to intermediate term, when I look at where I think 10-year bond yields are ultimately going to probably settle out by year end, I'm in the camp where we're still in this downtrend from late 2023. And I've been talking about 350, 375 as really where I think 10-year bond yields will sort of shake out at. We're below a declining 50 and 200-day moving average. So the trend is still lower in terms of yields at this point in time. And then thinking about the trend for 2-year bond yields and how that sort of aligns with Fed funds rates, that has definitely been getting weaker also in terms of those yields. So I think we're going to see rates generally work their way lower, whether it's 2-year or 10-year yields from that perspective.
Yeah, and obviously there's a lot of ways we can see bond yields rally. There's good ways and there's bad ways. And
Correct.
Right now with the government shut down, obviously not getting a bunch of the jobs data that tend to be very influential on both the long, the short end and Fed expectations. So hopefully we'll get the government back to work. We'll see what the employment data looks like. And, maybe until then, the market's got a bit of angst here with respect to inflation and Powell's kind of hawkish message. Next week, we'll hear probably from the Supreme Court on tariffs. So there's certainly a lot of angst around interest rates, and it's not any easier with a lot of data that we're used to getting. We're not getting into year end. So hopefully we normalize on that front. I want to ask you about you talk about breadth a lot, and obviously, we've been in a multi-year backdrop where the market's been clearly led by some larger companies, and we've had these fits and starts of breadth getting better, but then kind of, as maybe we're seeing again, not really sustainably holding. How have you thought about, as a technician, looking at breadth data and its message for the overall market that today is so skewed towards so few names? Is it as indicative as it usually is? And how have you navigated this kind of new backdrop of concentrated equity markets?
Yeah, fabulous question. And, to the one point you also just made, Michael, about, the Fed and, 25 basis points this week. I'll just add in this real quick, is it seemed like, hey, we're going to give you 25 now. Things are closed. Market got ahead of itself thinking that there were going to be a 25 and a 50 priced in this year. And this was sort of a way, I think, for Powell to almost tap the brakes on this equity rally in the short term. And I think that's exactly what they did. And I think that was probably a healthy move. Now, to your question about how do I think about breadth throughout history and what we've been seeing here lately. Historically, if you think about most bull markets going back in time, since 1945 or post-World War II, there's really, when you break it up into quartiles, you tend to have fast starts, you tend to have slow middles, and you end in a blaze of glory. And in that blaze of glory, you typically have a narrowing sort of market breadth is what you typically get. Now, that's not to say that it's going to be an immediate sell-off when the breadth narrows. But if you go back and you think about the 1970s and study those periods when you had your kind of nifty 50 environment that was taking off, it was a very narrow market back then. And the market we're getting right now is definitely narrow. You look below the surface, there's a lot of stocks that have rolled over. And the way that I think about it and sort of process a lot of this is if I'm getting a deterioration in market breadth, it makes me a little bit more cautious. And this is part of the reason why we have not raised our year-end price objective that we've had out there since November of last year at 6,600. We certainly knew that when the market collapsed into the April timeframe, that was not the time to lower a number because all of our measures of breadth in the market were extremely oversold. Back then, in fact, we had 5 indicators that we typically have looked at that were extremely oversold. Not the time to think that the market's going to go lower. But where we are now, the market needs to digest some of these gains. And the breadth measures that we saw just this week, Michael, where we had the S&P 500 higher on the day, and 80% of the stocks were actually lower. A quick study that we had pulled together and we're going to use in our up-and-coming publication showed us that basically the last time we saw any sort of activity like that was back in 2005 and 2006, and start trying to put together the pieces of what was happening back then. We also had gold making an all-time new high for the first time in 26 years back then. And we've also have that happening now. We also had tight credit spreads that you've been talking about happening too. And so how do I think about breadth? Breadth does not mean that the market has to end today, weaker market breadth, but is certainly a sign that the generals in the market are leading. And usually when the generals in the market are leading and then they start to roll over, the market usually sees a broader pullback or sort of correction that can ultimately play out. But that doesn't have to be today. That could be 12, 18 months down the road, but we have to pay attention to it.
So you're talking about history there, which one of the things I wanted to talk about with you is how the industry or the market composition has changed and how that has been represented in your work in the technical field. Specifically, one of the things we've seen over, Michael and I have been doing this together about 20 years, the rise of factor investing. That has become just so much more important. And one of the most important factors, momentum, which kind of falls into your camp. How has that changed and how has it affected your process with the rise of retail investing? And are there just so many more people following these technical indicators? And does that explain some of this crowdedness in this movement? Does it explain some of the things we've seen in gold and Bitcoin? What's your take on that?
I think that's a fabulous question, Stephen. So I've always said, a little tongue in cheek, that the quants stole momentum from the technicians because the technicians have been using momentum for a very long time. And I think the way that this market has changed is super interesting. You're right. We have more information out there than ever before. And we've also had a sort of structural change that's happening, which I think actually makes quants more important. And it also certainly makes technicians even more important because you're right. It is becoming much more of a momentum-driven market. But what's driving this market to be even more momentum-driven is, yes, factors, but is also the compositional change. We now have more ETFs than we do individual stocks in the market. To me, that's a bit of a concern, okay? Which means that this market is probably going to operate more like a light switch than it is a dimmer knob. And investors talking about valuation in this market, Michael, remember when you and I were doing the presentation in Nashville and I asked the question to people, I said, how many people here own an ETF? Everybody pretty much raised their hands. And then I asked the next question, which was, how many of them bought that ETF because it was cheap? And the answer was none. And so you're ending up with a market that's becoming more thematic driven, more momentum driven. And this is where I think the quantitative aspect of this and also the technical aspect of this is becoming more important and more relevant every single year. because from a pure fundamental perspective, I think you've got to use a wider notion of what valuation means than you've had before. And the reason I say that is because of all these ETFs. Nobody's buying them because they're cheap. It's not really a valuation argument. And then lastly, I'll say this too. I was looking up just the other week with a good client of ours at lunch, and we were looking at several stocks. Some of these stocks, and doesn't matter which one it is, but we were sort of surprised to learn that some of these semiconductor stocks we were looking at, they are in over 260 ETFs, okay? So just the pure money flow and trying to understand where those funds are going might be more important than sort of anything else, because the buyers from those ETFs are not valuation sensitive. They're just trying to match a benchmark. And I think that's why this is more important.
We hear from clients all the time asking us when single stocks in their universe are making strange moves. And sometimes you find out, oh, this stock is in these bunch of different baskets and ETFs that people are trading collectively, and it's influencing individual stocks, and really oftentimes for no fundamental reason. And, one of the things, I spend enough time on X and listen to the retail audience, and my hypothesis, I don't have any data to prove this, but certainly a gut feel that's really strong, is that when I hear retail money, I think technical money, momentum money, because when I listen to retail investors talk about the market, talk about their stock ideas, they're always talking about some technical trends and technical indicators. Almost never is it a DCF story. Even if it is a fundamental story, the real catalyst for decision making is really about technicals. So I think what you described, Craig, what Stephen mentioned, in a way, it's like this stars aligning for the momentum factor, because the confluence of passive investing, the easier access to trading, short-term myopic thinking, and just a lot more people in the market and people using a lot of the same tools and thinking the same way.
Yeah, and I would also add to that too, is that you're right. A lot of the younger investors in the market right now tend to be more visual, growing up playing more video games and those kind of things. And they gravitate toward a visual experience on the market. And yeah, they're talking about charts. As a past president of the CMT Association, I can tell you a lot of the younger folks that are coming up, they're very much focused on charts, patterns, and everything else. But when you talk to the veteran, older technicians like Ralph Acampora or Luis Yamada, they'll all tell you that the most important thing you got to think about is just price. Because everything else, whether it's a momentum factor, it's our mace work, it's breadth, it's everything else, it's all based upon price. So really understanding that trend is important. And then lastly, just thinking about the rise of these ETFs and what individual investors have been doing. I think it's very smart of you to be spending time looking at what's happening with Twitter and some of those messaging feeds, because when investors get nervous about things like we saw earlier this year around tariffs, and all of a sudden they watch their portfolios go down, it becomes sort of a self-fulfilling process. And they're not selling just one stock anymore. They're selling 500 stocks or 1,000 stocks on these single ticker decisions on these ETFs, which adds more volatility, which also makes it more challenging, because the drawdowns that we often see in this market tend to be very quick, and they tend to be larger than what we've seen in other periods. And I've seen that with my breath work, Michael. When I go back and I look at our 40 week and how many times we've gone from 0 to 80 on that breath work post the great financial crisis in 2007 to 9, it's been 50% higher from post the great financial crisis than the period from 1987 to the great financial crisis. So we need to accept more volatility, more drawdowns, which leads people to have to accept a lot more volatility in their portfolios, which is a challenge.
Markets, as far back as you can go, have kind of always overshot on both the up and the downside. And the market structure today and the rise of information and investors just makes you wonder, was the meme trend where these ridiculous highs and then crashing down foreshadowing what could be coming for markets in the decades to come?
I think that's an astute observation, Stephen. I think this is a market that's definitely going to be much more volatile than we have seen.
Your light switch analogy.
Yes, the light switch analogy comes into play for sure. And this is where I think the technicals can be as useful for sourcing ideas, but they can also be a very good risk management tool along the way too. And again, just trying to keep things simple and sort of understandable for people in a market that's becoming more complex with options and ETFs and all sorts of different changes. The technicals are a good way to simplify it, visualize it, but more volatility. We're going to have to deal with that in the future. I really do think that cash should be a strategic option for people, more so today than it has been in the past. I know that is sort of, you're not supposed to say that in our business because they want people fully invested at all points in time. But at the end of the day, I do think there are periods where you can really make money in this market. And there's other periods where you're really difficult if you're a long only manager to make money because you're getting a market that is so either all working or all not working with the rise of all these different ETFs.
Well, it does definitely feel a little bit like that feeling you get in my case, Atlantic City at the blackjack table. You get these streaks where you can't lose, and then you get these streaks that feel longer and you can't win. But as long as the policymakers keep pumping in oxygen into the room, hopefully things can continue to go in the right direction from an economic and market perspective. So let's wrap it up, Craig, and give us a minute or so on how you think things are going to kind of end the year, the next 2 months. You talked about breadth weakening. Is this a sign of something worse to come into year end, or do you see the market settling out and having its normal seasonal pattern of strength into December?
Yeah, so this year, in terms of seasonality, Michael, has been anything but normal. It's been kind of the year of the opposites. People were looking for a correction in the August-September timeframe. Seasonality is typically strong in the November timeframe. I still think we can have a rally into year end, but I think it's going to be coming from a bit of a lower level. I think we need to have some sort of shorter term pullback. The breadth measures are very interesting in here from our perspective right now. And as I look at the fact that we're at the very upper end of some of these technical indicators like Bollinger Bands, you're at some of these standard deviation thresholds where you really do need to see the market pull back and sort of reset. So look for a short-term reset over the next, I think, few weeks. And then I think you'll find a healthy environment for a stronger, like higher in the year end. Do we close over 7,000? Possibly could be the case, but I'd be more interested in sort of reevaluating price targets and those things on a pullback versus trying to press our luck right now the way it is.
All right. Excellent. Great having you here, Craig. You do great work and a big part of what Piper Sandler offers on the markets, macro, and equity research front. So thanks for joining us. And we'll get you back some point in the first half of the year and see what your tools are telling you at that time. Thanks.
Thanks, Michael. Thanks, Stephen.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Kantrow. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.